Hey guys, how's it going? Lewis Howling Investor and welcome back to my channel. In today's video, I'm going to be going through 3 UK stocks to buy now in August 2021. A few of these stocks I actually own in my personal portfolio and I think they are a few outstanding picks going into the future. They're all listed on the London Stock Exchange and most of them are quite big companies which you've probably heard of. Let's get straight into it. So yeah, the first stock on my list for this month is BHP Group PLC, and this is a stock I actually own in my portfolio. Who are PHP? So BHP Group PLC and BHP Group Limited are an Anglo-Australian multinational mining company. They are dual listed, so that means they're listed in Australia, in Sydney, and in London on the London Stock Exchange. By 2017, BHP was the world's largest mining company by market cap. So they're a massive mining company. They've been around for a long time, since the 1800s, as you can see. They're one of the biggest companies on the London Stock Exchange as well. From my analysis of BHP Group, you can see some pretty impressive results. You can see that most of my pillars are in the green. For the sake of time, I've got rid of pillar 2, which is to do with management. So I've only included pillar 1, 3 and 4 of my 4 pillars of stock investing. Pillar 1, you can see that the company has very high margins, high returns on capital, and it's doing this with low amounts of debt. Overall the profitability of the company and the return on capital is absolutely fantastic, and this is a company, these are features in a company you really want to see. Then moving on to pillar 3, you can see that the revenue's growing, the profits growing, cash flow's growing, the dividend as well is one of the main factors of this stock. It's currently at a 5% yield, which is absolutely fantastic. The company is benefiting shareholders by paying out a lot of their cash flow through dividends, which myself, what I'm currently doing is when I get the dividends of BHP, I'm buying more stock. So overall, it's a win-win really. On to pillar 4. So pillar 4 is the ultimate stumbling block most of the time because you need to be buying the stock at a fair price. You can see that the PE ratio is 22, so it's slightly higher than where I would like it, especially for a company of this size and the low but stable growth it's going to have. The price of free cash flow is low, so when you're buying this company, you're buying a lot of free cash flow, but maybe the earnings isn't as important as free cash flow really, as you can see from the DCF calculation. So I value the stock at about £21 at the moment. You want to see around a 5% decrease in the stock price, but this isn't under the realms of possibility. In 2020, the stock was trading around £15 to £16. At a 10% return and dividend yield like that, you cannot complain at all really. Let's move on to the DCF calculation and I'll tell you how I got to that. From a DCF calculation for BHP, you can see that I'm valuing the company at around £21 to £20 per share, and at the current price of £23, it's not too far off. So if you wait for a pullback, and this is what I'll be doing when I've got more funds ready to invest, I'll be probably looking to buy more shares of BHP. Pretty good stock really. It's an interesting company. Mining companies are absolutely booming right now, mainly because of the commodity prices going really high, which means better sales, better profits for these companies. But ultimately, these mining companies aren't going anywhere. So with the amount of profits they're producing, it looks like a good stock for the long term. So stock number 2 on my list is Barratt Developments PLC, and Barratt's, or let's just call them Barratt's as that's what they're usually known as, they're the largest property development company in the United Kingdom. They were founded back in the 50s and have been listed since the 60s, so they're a massive house builder in the UK. In terms of size, the market cap's only around 7 billion, so compared to the previous stock BHP, it's a lot smaller in size, but even still it's a very big company. Like I just said, one of the biggest house builders in the UK, so it's got a lot of good tailwind going for it. Now having a look at my analysis, you can see that it's pretty much all in the green again, apart from a few red points. You can see that on the pillar 1, everything but the return on capital section is in the green, so they're very profitable. They don't have much debt at all, which is fantastic. Long-term debt, short-term debt. That's all good. The return on capital is a bit lower than I'd probably like to see, but you can't have everything and no stock is perfect, apart from Google and Facebook, cough cough. Now on to pillar 3, and we're looking at the profit growth. Free cash flow growth is No. Essentially in 2020, so during the pandemic, they had a bit worse results than a few previous years, hence why that's in the red. But what's interesting is over the past trailing 12 months, these figures have changed completely, and because of the housing boom in the UK over the past 12 months, they've absolutely been flying off the shelves. So the way the financial year fell for Barratt's, it basically meant that their results looked worse than they probably were than they should have been, because essentially in like March, April in 2020 they just shut all the building sites for like 3 or 4 months, but when they got going again the demand was absolutely mental, and yeah, it's showing in the results now. And yeah, Barratt's dividend is currently 1%, and this was cut due to the pandemic. Pre-pandemic, this was closer to 4 or 5%. So if you're holding this stock and thinking, oh, I'm only going to get a 1% dividend, I'm sure that, after the pandemic's gone and things are back to normal, this dividend will be reinstated, because it's one of the key features of these, housing companies. So yeah, ultimately, it's looking pretty decent for Barratt's in terms of a stock pick. It's ticking quite a few boxes for me. Then I'm looking at the price ratios, and yeah, I'm looking at the price ratios. PE of 18, and when I put it into my DCF calculation for a 10% return, it's looking good. A 14% increase till its fair value of in the £8 range. So yeah, ultimately this is looking really interesting, and I'll go on to the DCF calculation now. I'm looking at the DCF calculation for Barratt. You can see it's looking rather promising for this stock. You can see my valuation is at £8.22 share price, which is a 14%, which would mean a 14% increase from the current price now. So yeah, looking rather good. I'm looking at a few of the house builders right now to add to my portfolio, and with the tailwinds, whatever you want to call it, for property, the demand for property in the UK everything is looking in the right direction. So let's get this stat out for you. So the top 10 house builders in the UK make 50% of all new supply, so they've got it tied up, and yeah, it's a pretty mad business really. They make a lot of profit, a lot of cash flows. The dividends are usually good, apart from pandemic, of course. But yeah, this stock is something it's totally on my radar, and it's looking very, very interesting as a pick. So the third and final stock on my list is Unilever. So Unilever PLC is the British multinational consumer goods company, and they produce all sorts of products you can think of, including food, condiments, ice cream, vitamins, supplements, all of that kind of stuff. So they're a massive consumer goods company, and all of their products are available in around 190 companies. So that just shows the size of them. They own over 400 brands, and yeah, they have all sorts of brands, including Lynx, Dove, Hellmann's, Lipton, Magnums, all sorts of stuff. And yeah, they're a massive company. What's the market cap? Just having a quick look now, 146 billion US dollars. So they're one of the biggest companies on the London Stock Exchange once again. And they've been around for a very long time, since the merger of Dutch margarine producer Uni and soap maker Lever Brothers. So yeah, massive company, and they've been around for a very long time. Now moving on to the analysis for Unilever, and let's go straight to pillar one. So yeah, the company is pretty profitable and high returns on capital. The debt is a bit of a sticking point now. They have slightly a bit too much debt for my liking. I would like it to see it lower than it actually is. So the debt is above 50% long-term debt to equity, and the current ratio, so the current assets do not cover their current liabilities, which is not great. Some industries are like this more than others. Consumer goods is one of them, but it's not something you want to see in all your stocks, let's just say that. Then yeah, pillar 3, let's look at the growth and the acquisitions, etc. So revenue growth is pretty stagnant, to be fair, which is a bit of a concern, because growth is where appreciation in the stock price comes from. But yeah, the cash flow and the profit has been up, but the revenue's been stagnant. So it's a pretty blue chip company. It's not going to grow at 10, 15, 20% a year like your Googles and your Amazons. Just not going to do it. So you want to see it growing its revenue by inflation each year, and you just want to see the profits staying consistent and not decreasing too much, because that's when alarm bells do start ringing. But then yeah, the acquisitions is pretty decent. They've got 400 brands, which a few of them have come through acquisitions. So like Ben & Jerry's, for example, that's one of the biggest acquisitions. I think they acquired them in the 90s or something like that. So They can incorporate brands into their ecosystem, and they can probably bring cost savings to them brands and make them more profitable because of the economies of scale. That's something consumer brands are very good at when it comes to acquiring. Shares have been decreasing, and one of the main things of this stock is the dividend. So 3.7% dividend yield, so it's a decent yield on a big company. So yeah, I just reinvest my dividends. So I think that's probably the right thing to do if you are investing for the long term. Yeah, so let's have a look at the price. So the PE ratio and the price to free cash flow ratio is in the red. So yeah, slightly too high on this. Yeah, you can see from the DCF calculation that I think that Unilever is worth from anywhere from £43 to £37 based on a 10% return. But ultimately this comes down to if you think the free cash flows of Unilever are going to stay consistent with inflation. Because if you think Unilever is a dying business and they're not going to do well over the next say 5-10 years, and these cash flows start dropping, ultimately the value of the business starts dropping. So ultimately it really depends on what you think the cash flow of the business is going to be. If you think Unilever are going to keep consistent, which I personally think they will, I don't see any reason why not. We're a very big consumer goods business. We have a lot of brands which people do seem to love, especially in the UK. And I see them ticking along like they always have done for the past 100 odd years. So that's just my opinion. That's one reason I do own their stock in my portfolio. Yeah, that's pretty much it with Unilever. If you think they can keep up with inflation, you'll be absolutely fine with this stock. But otherwise, if you don't think they can keep up with it and they're a dying business, then obviously you're not going to invest, are you? So pretty simple really. So there we have it. There's my 3 UK stocks to buy now in August 2021. Yeah, I really hope you enjoyed today's video. My 3 stock picks, BHP, Barratt and Unilever. If you'd like to learn more about investing, please subscribe to my weekly newsletter, The Harding Herald. It's full of cool investing content and the 4 or 5 biggest stories, in my opinion, of the previous week, all summarised in the newsletter with a few memes and YouTube videos to go alongside it. So it's a good market recap, market roundup of the previous news of the week. I don't really talk about much price movements on there because they're pretty pointless, but I do have the market data on there to show where the major indices are, from the previous week. So yeah, thank you very much for watching today's video. I mean, if you did enjoy it, please leave a like and a comment, as it really does help me out. And if you are new around here, please subscribe to the channel. Thank you very much for watching. I will see you next time.